Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, good morning, everyone. So today we're going to talk about the Black-Scholes option pricing model. Right? So the most quintessential equation behind the option pricing. So a quick recap. So basically last week we talked about the binomial option pricing framework. So in the binomial option pricing framework, basically we're kind of using two strategies. The first is the replication approach, right? So we replicate a payoff of a call option. And second, we used something called delta hedging, remember? So basically, the whole point of delta hedging is we short a call option, and because we shorted the call option, we know that we are exposed to risk, right? So what kind of risk? When the share price gets above the strike price, the holder of the call option will exercise against us, and we're going to make a loss. So basically, we decided we're not going to short a call option and doing nothing. So what we did is we short a call option, then we bought delta unit of shares. Remember, that was the recipe. And once we bought delta shares and we short a call option, we managed to construct a portfolio that is riskless, right? So we show that that portfolio have a certain payoff at the end of the maturity. Because it has a certain payoff, so this portfolio acts like a fixed income security, like a riskless zero coupon bond that guaranteed to make a fixed payoff. Then we kind of argued that if this portfolio is riskless, then perhaps we can discount the portfolio back to the present using the risk-free rate. And risk-free rate will be the appropriate rate to discount that riskless portfolio. Remember? So that was with the whole delta hedging portfolio strategy. And today, we're going to use the same analogy. We're going to use the same rationality to kind of derive the Black-Scholes option pricing model. We're not going to derive the whole model. We're going to derive the Black-Scholes partial differential equation. Okay, so that's a quick recap about the last week knowledge. So in today's lecture, first we're going to talk about the assumptions behind the Black-Scholes option pricing model, then we're going to touch a little bit on the Black-Scholes theory, and then we're going to look at how to apply the Black-Scholes analytical solution to calculate a call and a put option price. So that's our key target. Okay, so first of all, I'd like to talk about the key assumptions behind the Black-Scholes option pricing model. So basically, the key assumptions is that the stock price follow a log normal distribution. Okay, so first of all, I'd like to mention that the entire section number 1 is not examinable. Okay, the whole purpose of, and also the section number 2 is not examinable either. So the whole purpose of doing this exercise is us try to have a better understanding behind the assumptions of Black-Scholes partial differential equation. So let me start from the beginning. So basically, Black-Scholes assume the stock price follow a log normal distribution. And this is what log normal distribution looks like. Now, you see that the stock price are bounded by 0, right? So this log normal distribution, you can see that the stock price is bounded by 0. And if you think about that carefully, that has some resemblance to the reality, right? Because in reality, the minimum the share price can fall into is in fact 0. And obviously, share price is not going to become negative, right? So that's pretty realistic assumption to make. The share price is bounded by 0. Now, you see this distribution is skewed to the right, right? Skewed to the right means there's no upside ceiling as to how much the share price can increase into. If you think about this, it's pretty realistic too, right? Because in reality, there's no upper limit as to how much share price can increase into. If the company is doing very well, share price can just go up and up. If you think about these two features of log-normal distribution, this is not a bad assumption to make, right? Do you guys agree with my argument that we're going to assume the share price corresponds to this log-normal distribution? And the reason we make that assumption is because in reality, that's how share price works, right? It's bounded by zero and it's skewed to the right. Basically, there's no upside limit as to how much share price can increase into. Now, if we can all comfortably accept this assumption, then I'm going to tell you, if you take a natural log on the share price, then what you're going to end up with is a normal distribution. So just let me say this again. The share price itself, ST, corresponds to this log normal distribution. And if we take a natural log on the share price, then what we end up with is in fact a normal distribution. Okay, so I'm just telling you this fact, but in the next section we'll try to prove that. We'll try to prove this is the case, all right? Okay, so basically, we're going to assume there's a process that underpins the movement of the share price. To be more precise, there's a process that followed by the natural log of the share price. So we're just going to call it log S. All right, we're going to give this process a name. So we're going to call it function g. So the function g is simply equal to log S. And we're going to argue this is the process that followed by log S. All right, then the next thing is that we are interested in how this process changes over time, right? In other words, we are interested in the delta g, the small change in the g for, the change in the g for a small time interval. In order to do that, we would want to differentiate g, right? So we would want to differentiate g with respect to the share price S, and also we're going to differentiate g with respect to the time t. Okay? So basically what I've done here is I take the first derivative of g with respect to share price S. Now if you do that, what we'll get is 1 over S, right? So that's me taking the first derivative of g with respect to the share price S. Now, I'm going to take the second derivative of g with respect to S. Now, if I do that, what I'll end up with is minus 1 over S squared. So this term, how do I get this term? I take the second derivative of g with respect to S. Okay, then remember what I said. I'm going to take the differentiation of g with respect to the time t. Because we don't have the time in this equation, so differentiate g with respect to t, what we'll get is nothing, 0. So that's what we have done. Then we're going to make another assumptions, okay? Another assumption we're going to make is our stock price S follows the geometric Brownian motion. And our stock price, how the stock price changes over time is that this is a geometric Brownian motion with an expected return mu and a standard deviation sigma. Okay? So basically, in other words, the ds, the change in the share price, has a drift rate of mu and a variance of sigma. Okay, so what is this dz term here? Now, dt just means small change in the time interval. Now, the dz represents something called Wiener process. And you can simply regard this process of adding the noise into the path that followed by the share price. So let me summarize this. The way we're going to model the share price move through time is that it has an drift term mu. So basically, mu is the expected return. So in other words, share price is going to grow at a rate of expected return. But it's going to be volatile through time. And the volatility is determined by this noise term here, dz. Okay? So the magnitude of this noise is determined by the standard deviation sigma. So the sigma times s times dz is going to add the noise into the path that followed by the share price. Okay, so that's the second assumption we're going to make about the share price. Okay, remember the whole point of us doing this exercise is try to differentiate G with respect to the share price. And remember, we take a natural logarithm on the share price. But the natural logarithm function is a nonlinear function, right? So when you differentiate a nonlinear function, in high school, what we did is we used something called Taylor theory expansion. So basically, Taylor theory expansion allows us to differentiate a nonlinear function. So here, we're going to use something very similar. It's called Ito's lemma, right? So this is the lemma derived by the mathematician Ito, a Japanese mathematician. So basically, this entire equation here is nothing but a fancier version of the Taylor theory expansion that we're going to use in a continuous time. All right, so this is something that derived by Ito. We're just going to take as granted, right? We're just going to use it. We're not going to derive Ito's lemma. And basically, we differentiate G with respect to S, and we differentiate G with respect to time t. Remember, we have already done the hard work. In the previous slide, we've done the hard work. We argued that if we differentiate G with respect to the share price, the natural log of the share price, what we will get is 1 over S, right? And this is us taking the second differentiation of G with respect to S. Also, we take the derivative of G with respect to time t. Now, if you watch this equation carefully, you realize we can actually substitute this term, right? We can substitute this term into this term here, right? So what we will get is 1 over S times mu times S. Then also, we can substitute this second differentiation into this term here, right? So if we do that, we're substituting minus 1 over S squared times sigma squared times S squared, right? So we get that here. And lastly, because differentiate G with respect to t, we get 0, so we're going to substitute 0 into this term here. So that's just a big fat 0. And then again, we're going to substitute 1 over S into that component there. Now you realize we can actually cancel out the S, right? Because we have S in the denominator, we have S here, we simply cancel out. Then we cancel out this S squared in the denominator with this S squared here, and we cancel out S. Now if we do that, we're going to end up with an equation look like this. Okay? Right, so let me reiterate. What we have done is we've taken these 3 equations, we substitute into Ito's lemma, and we simply rearrange the equation, we did some cancellation, and we end up with this equation here. Now, what does this end result tell us? This end result tells us the function G, remember the function G is the process of the log of the share price, follows a generalized winner process. All right, it has a constant drift of mu minus sigma squared over 2, and it has a constant variance rate of sigma. Okay? So more formally to put it is that we know the change in the log of the share price between time 0 and the time t is the difference between the two, right? So that represents the change in the log of the share price. And that is normally distributed with mean of mu minus sigma squared over 2 times t. Because now we have the t here, we have the t in the subscript. So this mean is scaled by the time t. And it has a variance term of sigma squared times t. So how do we get this distribution? We derived by using the Ito's lemma, right? So that's just your mean, and that's the variance term. Sorry, that's the volatility. If you put a square on that, that's your variance term, right? So basically, the process of the G has this expected return part and also having this noise part, all right? So this noise part is determined by the size of the standard deviation. So how volatile is the underlying share price? Right, so that's what we derived. And we can rearrange this equation. So by rearranging the equation, we can put this minus log S0 inside of the square bracket. Right, so all I have done here is I put this minus log S0 inside of the square bracket. Now, if I do that, I can argue that log of the share price, log of ST, is normally distributed with mean of log S0 plus mu minus sigma square over 2 times t, and it has a variance term sigma square times t. All right, so that's our distribution for the log of the share price, ST. So effectively, we have proved what I said in the beginning of the lecture. Remember, I said one of the important assumptions behind the Black-Scholes option pricing model is that Black-Scholes assume the share price is log normally distributed. And all we have done is we take a log on the share price, then surprisingly, we end up with a normal distribution. And that is your normal distribution, right? So as I mentioned, this is not examinable. I'm not expecting you to learn this, but having done this exercise help us to have a better understanding behind the Black-Scholes assumption. All right, so that's your distribution for log of share price ST. And then, having this is very handy because later on we're going to make probability inference from the normal distribution. So what do I mean by that? Let's have a look at this question here. So this question says, find the probability distribution of the stock price in 6 months. And for a stock with the current share price of $50 and expected return of 20% per annum, a volatility of 30% per annum. Right? So a quick recap. From the basic stats course, we know that the 95% of the area of a normal distribution is within 1.96 standard deviations of its mean. In other words, 95% of the area is between minus 1.96 and positive 1.96, right? So roughly you can say 2 standard deviations from the mean covers 90% area underneath the curve. And we're going to take advantage of that. Then we're going to calculate a 95% confidence interval, and that 95% confidence interval is going to give us some indication of the range of the price that this stock price might end up with in 6 months' time. All right, so it should be fairly easy because we've done the hard work. We derived the distribution of the log of the share price ST, and we know the current share price is $50, and we know it has expected return, so the expected return is our mu here. The expected return is 20%, and the standard deviation. So when a question tells you the volatility, it meant standard deviation. So the standard deviation is 30%. All right? So we simply plug in the current share price 50 into the log S0 here, and we plug in the mu, which is our expected return, 20%. Then we plug into the volatility 30%. So that's 0.3 squared over 2, and times 6 months. So that's expressed in a fraction of a year. So that's 6 over 12, 0.5. And what we have derived earlier on was the variance, right? So the variance is sigma squared times t. The volatility or the standard deviation simply square root of that. If you take square root of the variance, what it will get is sigma times square root of time t. So that's simply 30% times square root of 0.5. And then what we get is the log of the share price has a mean of 3.99, has a standard deviation of 0.212. Now, once we have the mean, we have the standard deviation, we can calculate the 95% confidence interval. All right? Okay, so remember what I mentioned before? With the normal distribution, we prove that when we take the log on the share price, we're going to end up with a normal distribution. Now, with the normal distribution, 95% of the area underneath the curve lies within 1.96 standard deviations of its mean, right? So basically, this has a lower bound of the mean, so the mean is 3.99, minus 1.96 times the standard deviation. You can think of this as the lower bound. Now the upper bound is simply the mean, 3.99 plus 1.96 times the standard deviation. Now, the next thing we do is we move this natural log outside, to the two sides of the equation. If we do that, we get this expression here. And then, with some calculation, we get there is 95% probability the stock price in 6 months' time will lie between $35.67 and $81.90. So that's the range of the share price. Sorry? Yeah. Yeah, we only have sample variance. Yeah, so empirically people use t-distribution, then people look at the t-statistics, then they convert that into the p-value. So p-value, p-value equal 5, that's the probability of type 1 error. So basically, empirically people use t-distribution. People use t-distribution in practice, yeah. So, as I mentioned before, this whole exercise is just us to have some understanding of one of the assumptions that made by Black-Scholes, okay? All right, so this is what we have done. And next, we're going to get the distribution for the continuously compounded rate of return. Okay, so the log normal property of the stock price is useful. It's useful in the sense it provides some information on the probability distribution of the continuously compounded rate of return earned on a stock between time 0 and time t. All right, so if we defined the continuously compounded rate of return per annum realized between time 0 and time t as this variable x here, then we can say that the share price will grow from S0 to ST at a rate of X over the time horizon T, right? So that's basically what we're going to argue here. And then we can rearrange this equation. We can get the rate of return is equal to 1 over T times the natural log of ST over S0. So the way I get this is simply by rearranging this equation. Okay, then luckily what we know is we know the distribution of log ST, right? We derived the log ST distribution before, and then we can rearrange that equation. We can get the distribution for the continuously compounded rate of return. So basically, the rate of return has a mean of mu minus sigma square over 2, and it has a variance term sigma square over t. Okay? So again, we're going to do a similar exercise. We're going to calculate 95% confidence interval for the stock return. So here is the example. So it says, consider a stock with expected return of 17% per annum and the volatility of 20% per annum. So it says the probability distribution for this average rate of return continuously compounded, realized over 3 years is normal. Then what we can do is we can use this formula here to calculate the mean for the rate of return. So we know the mu is 17% minus, so the volatility is your standard deviation, minus 0.2 square divided by 2. So we get the mean is 15%. And the standard deviation is simply, we're taking the square root of this term here. And that's square root of 0.2 square divided by 3 years. So we get the standard deviation is 11.55. And once again, we can calculate a 95 confidence interval, right? We know what the mean is. The mean is 15% minus 1.96 times the standard deviation. And for the upper bound, we have 15% plus 1.96 times the standard deviation. So in other words, when 95% confident, the average return realized over 3 years will lie between minus 7.6% and plus 37.6% per annum. Okay, so having some understanding of the log normal distribution, we can now get to our real business, which is to talk about the Black-Scholes option pricing model. But before getting into the option pricing model, let's first have a look at some of the assumptions the Black-Scholes has made in their original paper. So we have already went through the first assumption. I said the stock price behavior corresponds to the log normal distribution. Right? So we discussed that earlier in the lecture. And the second assumption that Black-Scholes has made in their original paper is that there's no friction in the capital market. So when they say there's no friction in the capital market, they really meant there's no transaction cost, there's no taxes, and all securities are perfectly divisible, which means you can trade a fraction of options, and alternatively, you can trade a fraction of stocks. And the third assumption they made is that there's no dividends on the underlying stock. And fourth assumption is that there is no riskless arbitrage opportunity, which means everything in the market is fairly priced. Everything in the market is priced at its equilibrium price. And the fifth assumption is that securities are traded continuously throughout the time. And in the number 6, they argue that investor can borrow and lend at the same risk-free rate, which means investor can access the same risk-free rate for their financing. And the last assumption they made is the short-term risk-free rate R is constant. So basically, short-term interest rate R does not change. So those are the 7 assumptions behind the Black-Scholes option pricing formula. All right, so next what we're going to do is we're going to look at how does Black-Scholes get their partial differential equation. So again, section number 4 is not examinable. So the whole point of us doing this section number 4 is try to get some intuition out of the Black-Scholes option pricing model. Okay? So let's have a look, how do they get the classic Black-Scholes differential equation. So again, we're going to start with something really basic. We're going to model the stock price movements through time. So first of all, we're going to assume the stock price follows the log normal dynamics, right? So that's what we did in the previous slides. So basically, we have a stock price that follows a generalized Wiener process. So basically, it has a constant drift term, mu, and it has a constant variance term, sigma. So this equation is mostly widely used in the finance literature. And the variable mu is basically stock's expected return, and sigma is the volatility. And this dz, again, as I mentioned earlier, you can regard that as adding noise to the path that's followed by the stock price. And the noise is actually determined by the size of the standard deviation, sigma. Okay? And then what we do is we use this lowercase f to denote the price of a call option. So let me say this again. We use this lowercase f to denote the price of a call option. And what's more is that this call option is contingent on the underlying share price. Right? It's kind of realistic because in reality, the decision to exercise call is contingent on how big is the share price. Okay? Then what is the absolute basics we know about this F, about this call option? We know the price of the call option must depend on the underlying share price, S, and also it depends on the time T, time to expiry, right? So in other words, to make sure our model is very general, we're going to use very little parameter here. We're just going to argue that our price of call option must be some function of S and must be some function of T, right? Then what we're interested in is how option price change over time. Now, in order to do that, again, we need to differentiate F with respect to the share price S, and we're going to differentiate F with respect to time T. And if you recall the intrinsic value diagram of a call option, is actually a nonlinear function, right? And as we did before, when we try to differentiate this nonlinear function, we need to use Taylor theory expansion. So again, that's where the Ito's lemma comes into play. So as I mentioned before, the Ito's lemma is nothing but a kind of fancier version of the Taylor theory expansion. So we're not going to derive that. We're simply going to use the lemma derived by Ito. So that's your Ito's lemma. And then what I did next is I simply write down the discrete version of these two equations, right? So the discrete version, I simply replace the D with the Greek letter delta. So basically, that represents the change of the share price in a very, very small time interval, okay? And I did the same thing to the change in the value of F, right? So all I did is I replaced the D with the Greek letter delta. So that this equation simply means the change in the call option price in an instantaneous moment. Okay, then what we realize is that the noise component that underlying the change in the share price and underlying the change in the call option price is the same, right? So they have the same delta Z. So the same delta Z means that if the noise components behind F and S are the same, then perhaps what we can do is we can construct a portfolio by shorting a call option and by buying some amount of shares so that this noise component is completely eliminated. So in plain language is that what we're going to do is we're going to short a call option and long this amount of shares. All right, so how much share we're going to buy? We're going to buy, the change in the call option price with respect to the change in the share price. So that measures how sensitive is the call option price with respect to the share price. And we're going to buy that amount of shares so that all the sensitivity to the call option price is eliminated, right? So this is analogy to what we learned last week, the delta hedging strategy. Remember, in last week, what we have done is we short a call option, so that's us shorting the call option, and we bought delta shares, right? We bought that much amount of shares. Then what we get is a portfolio that is deterministic in value, which means that portfolio would guarantee to make a fixed payoff in time T. And then last week, what we argued is that if this portfolio provides a fixed payoff, is riskless, is similar to a riskless zero-coupon bond, then what we can do is we can discount the value using the risk-free rate, right? So that's what we established last week. So similarly, in Black-Scholes option pricing formula, they use the same ideology. Okay? So when the appropriate portfolio of stock and call are established, the gain and the loss from the stock position is perfectly offset by the gain and the loss from the call option. So the overall value of this portfolio at the end of a short period is known with certainty. So there's no uncertainty about the value of the pie, right? So value of the pie is the value of this riskless portfolio that we constructed. Okay, again, I'm going to write the discrete version, which is the delta pi. So delta pi really represents the change in our portfolio value in a very small time interval. And that's the change in the call option price and that's the change in the stock price. Okay? And luckily, we know what the delta F is. So going back here, the equation number 2 tells us what the delta F, right? So what we can do is we can substitute the delta F into here. And also luckily, we know what the delta S is. The delta S is simply equation number 1, right? So we established the delta S and the delta F before. Then what we can do is we can substitute equation 1 and 2 into our equation number 4, right? So if you do that with some rearrangement and some cancellation, what we'll get is the delta pi. So the delta pi is equal to this expression here. It's our equation number 5. Okay, so let me reiterate. The way we get equation number 5 is we substitute the change of the share price, equation number 1, and the change in the call option price, equation number 2, into our equation number 4, which is the change in the pi. All right, so that's the change in the pi. And as I mentioned before, because this portfolio does not involve the noise component, delta Z, so this portfolio value is deterministic. This value of the portfolio so the portfolio must provide us a fixed payoff at the end of time t. Now, if that's the case, then the change in the pi, in other words, the instantaneous rate of return earned on this portfolio pi must equal to the risk-free rate of return, right? So that's what we argued. The change in the pi is determined by the risk-free rate of return, because this portfolio does not involve any noise term, does not involve the delta Z, so this portfolio is deterministic, this portfolio is riskless. Therefore, the change in the pi must be driven by the risk-free rate. Okay? And in other words, the value of the change pi between 0 and time t, this small delta t time interval, is the pi 0 times the risk-free rate, 1 plus the risk-free rate, then we will get the pi t. So that's the change in the pi, determined by the risk-free rate. And then we know what the delta pi is. The delta pi is simply equal to equation number 5. And also we know what the pi is. The pi is simply equal to equation number 3. So if we substitute equation number 3 into the right-hand side, and we substitute equation number 5 into the left-hand side, we're going to end up with equation number 7. Okay? So the way we get equation number 7 is simply substitute the delta pi into the left-hand side, which is our equation number 6. The delta pi is equation number 5. And then we're going to substitute the pi, which is our equation number 3. Sorry, there's a typo. So this is equation number 5. Equation number 5. Into our equation number 6. What we'll get is this equation here, equation number 7. Right? It's just a matter of rearrangement of equation number 7. We're going to get equation number 8. So equation number 8 is our quintessential Black-Scholes-Merton differential equation. And so this is the equation that Fisher-Black and Maron-Scholes got in their 1973 paper. Then Robert Merton did some other work. So basically, Robert Merton solved this partial differential equation with some boundary conditions. And so all of the three is actually awarded Nobel Prize in 1997. And unfortunately, Fisher-Black passed away in 1995. So only Maron-Scholes and Robert Merton received the Nobel Prize in 1997 for coming up with this equation here, equation number 8. Now, solving this equation with the boundary condition is really beyond the scope of this course. So we're not going to do that. But if you can solve that with this two boundary condition, which is the payoff from a European call and payoff from a European put, you will get the analytical solution for the call option price and the put option price. So basically, the call option price is equal to the current share price times this ND1. So this ND1 is a probability term, minus the present value of the strike price. So that's just the strike price discount back to the present times ND2. So ND2 is also a probability term. So the way we get ND1 and ND2 is by using these two equations here. All right? Then once we calculate the once we calculate D1 and D2, we're going to look up the probability from our statistical table, and then we plug into this equation, we get the call option price. And similarly, that's how we get the put option price. So let me say this again. You don't need to know section number 4, which is the theory behind the Black-Scholes equation, but we need to know section number 5, which is the application of the analytical solution to the Black-Scholes differential equation. And that basically is the formula that underpins the pricing for the European call and the pricing of European put. So I'm going to give you guys a 10 minutes break. After the break, I will talk more about this equation, and I'll talk about the intuition behind the Black-Scholes option pricing formula. Okay? 10 minutes break. All right, guys, so let's resume the lecture. Perhaps we can finish early today. So, as I mentioned before, this, for calculation of the European call and put options, you need to do some preliminary calculation, right? So D1 and D2 are really just preliminary calculation. And usually the first two things you do is you calculate D1 and D2, and then you look up ND1 and ND2 in your statistical table. Then you plug in the ND1 and ND2 back to the equation, and you can work out the call option price. So we're going to do that in a second. It's fairly straightforward. And the next thing I want to talk about is I want to talk about some intuition behind the Black-Scholes formula. All right, so that's the Black-Scholes formula to calculate the European call option price. Well, you can simply look at this Black-Scholes formula as some sort of equation, as something you plug into and you spit out a call option price. You can think of that. But alternatively, we can think of this equation with a bit more intuition, so help you guys to remember it. So when I look at this equation, I would like to start with the back end of this equation. So I'm going to start with this second half, okay? First, let's think about what is the call option. If you exercise the call option, it just gives you the right to buy the underlying stock at a strike price X, right? And when I look at the back end of this equation, I see this minus sign here, right? So the minus sign is kind of telling us that, right, if we decide to exercise this call option, we will going to pay this strike price, right? Now, this strike price is paid at the maturity date because this is a European option. So we're going to discount back this strike price back to the present. So that's the minus X times the E to the power of RFT. That's just basically what it tells us. All right? Then what is this? So that's what I mentioned with discounting the strike price back to the present. Now, what does ND2 try to measure? Because 1 minute ago, I was talking about this European option as if we are going to exercise it. But there's no certainty that we will do that, right? There's some uncertainty the call option can finish in the money. There's uncertainty the call option may finish out of money. If finish out of money, we don't exercise the call. So it begs the question, what is the likelihood the call option will be in the money? In other words, what is the likelihood we are going to exercise the call and pay the strike price X? So the ND2 term tell me the probability the option finishing the money. So the ND2 term tells me the probability that we are going to exercise this call. If we're going to exercise the call, we're going to pay minus X, right? So that's just the back end of this equation. So I just explained the easy bit, which is the second half. So the front bit is a bit more difficult to explain. So basically the logic here is that if the call option finish in the money and you exercise it, you pay the strike, what you will get is the underlying stock. In other words, if the call option finish in the money and you exercise it, the end outcome is you get the ownership of the stock. Then it begs a very interesting question. How big the share price is likely to be, right? So how likely is that we are going to exercise this call option? So basically this S times ND1 is the expected share price in time t conditioning on the decision to exercise this call, right? So let me say this again. So this entire term tells you the expected share price conditioning on the call option finish in the money and conditioning on the decision that we are going to exercise this call option, right? Now, if you exercise the call option, then the call option price is simply equal to the S minus X. So that looks a lot like the payoff function that we learned in week 4, right? Does it make sense? Just go home, look at this equation a couple more times, And basically, the ND2 give you the probability the call option finish in the money. If it finish in the money, we're going to exercise it, and we're going to pay this much strike price. So that's the minus X. And if we exercise the call option we are interested in, how likely is the share price is going to be? So how big is our share price is going to be, right? So the ND2 term is, the ND2 term times the S tells us the expected share price, conditioning on the decision that we're going to exercise this call option, the call option finish in the money. Okay, so that's just a rough intuition behind the Black-Scholes option pricing formula. Okay, so let's do one quick exercise, see how we actually apply it with some numbers. So this question says, suppose that Woodside per trillion stock price is $10.50. The standard deviation of the return on Woodside per trillion is 30%. The riskless rate of interest is 5% per annum. So what is the price of a 2-year European call option on Woodside per trillion stock with the strike price of $8? So every single time when I apply the Black-Scholes formula, I think as a 3-step procedure. So the first step is to calculate your D1 and D2. And the second step is to look up the probabilities, which is your ND1 and ND2, in your statistical table. Then the last step is simply plug everything into your Black-Scholes formula. So let's start with D1 and D2. We know what the stock price is. The current stock price is $10.50. It has a strike price of $8. Risk-free rate is 5%. Volatility, which means the standard deviation, is 30%. So just be aware this is sigma square, so that's 0.3 square divided by 2 and multiplied by the time horizon t, which is 2 years. Then divided by sigma times the square root of time t, and we get D1 is 1.088. So because our statistical table only run up to 2 decimal places, so I would recommend you to keep to 2 decimal places in this step. So in other words, we're going to run up to 1.09. Once we get our D1, we're going to plug into the D2 formula. So the D2 is equal to the D1 minus sigma times square root of time t. And if you do that, you will get 0.6645. So that's just roughly equal to 0.66. Yes? So D1 is not probability. So ND1 is the probability. ND1 is the probability. So basically, yes, that's what I'm going to explain in a minute. So you've seen this Z table before, right? So Z is simply the standard normal random variable with mean of 0 and the variance of 1. So we know the value of Z, we know the value of D, so that's the D. And the ND1 is the shaded area underneath the bell-shaped curve. So that's what we're going to look for. So let me repeat. The D is not probability. The D is, you can regard that as the Z value, right? And the ND1 give you the shaded area underneath this bell-shaped curve. So let's do that. Let's find what is the ND1. You'll be given this table in your exam, in your final exam. So there are 2 tables, one table to look for the positive value and another set of tables to look for the negative value. All right, they look very similar. And remember, what we get as D1 is positive 1.09. Now, the way you look from the table is first we look down, 1 here, and then we look across to the right, all the way to 0.09, so that's 1.09. So the 1.09 corresponds to a probability of 0.86 to 1. So we quickly write down the ND1 is 0.86 to 1. Then we're going to do the same thing for ND2. We know the D2 is 0.66, so go back to the table. 0.6 is here, right? Then we look across to the right, we find the 0.66 correspond to a probability of 0.7454. Then those are the two values we're going to plug into the Black-Scholes equation to get our call option price. Okay, so we know what the current share price is. The current share price is $10.50. $10.50 times the probability, so that's the ND1, then minus the present value of the strike price. So strike price is 8 times the e to the power of minus 5% times 2 years. Then it times the ND2. We find the ND2 to be 0.7454. Now, if you do that, you will get the call option price with the strike $8, 2 year to maturity is priced at $3.66. So there's nothing difficult there, right? 3-step procedure. First, calculate D1, D2. Second, find ND1, ND2 in this table here. Then lastly, plug everything into this Black-Scholes option pricing formula. Then you get your call option price. Right, so it's quite straightforward in terms of pricing the option. All right, this table, I've talked about this table back in week 4, so let me go through this again. So what about, so basically this table tells us what kind of factors that would affect an option price. Now, if we holding everything else constant, all right, so if we're holding the strike price, time to maturity, risk-free rate, volatility constant, for higher share price, that's good for the call option, right? Because the higher share price means that your call option is more likely to be in the money and you are more likely to go into exercise the call, so that's good for your call option. And vice versa, the higher share price means that your put option has to work a lot harder to become in the money, so that's bad for your put. So that's the positive effect on the call, negative effect on the put. Now, holding everything else constant, having a higher strike price means that our call option has to work a lot harder to get in the money, so that's bad for the call option. So this downward arrow means it's negative impact on the call option, and it's good for the put, right? Because that means your put option don't need to work that hard to become in the money. And the longer time to maturity are good for both call and put, because longer time means now you have more opportunity to become in the money. So that's both good for the call and the put. And the risk-free rate, as mentioned before, that risk-free rate really provide a basis for the expected rate of return on the underlying stock, which means that you expect the share price to be higher. So the higher share price is good for the call option and bad for the put. And finally, volatility. So having a higher volatility are both good for the put and call, because having higher volatility means you have more chances to become in the money, right? So the share price become more volatile, more opportunity to become in the money. So basically, that's just a rough summary in terms of what kind of factors affecting our option price. Then I'd like to talk about the implied volatility. So remember, going back to the Black-Scholes equation, what we did is we use the volatility, going back here, is we use the volatility as an input, right? So we use the volatility in D1 and D2's equation to calculate the call option price. So that was the volatility we used as input, as a known variable. But a lot of time in financial markets, portfolio managers would look at the volatilities implied by the call or put option price as kind of index to measure how much uncertainty will happen in the future. So let me say this again. So usually people use volatility as an input to calculate the option price, right? But sometimes we like to get a forward-looking guidance in terms of how much uncertainty is in the future time period. So what we do is we grab a bunch of call option price or put option price, and then we back out what kind of volatility people are using to price those options. And those backed out volatility is called implied volatility. Basically, it's the volatility implied by the option price traded in the market. Okay, so let me show you one quick example how people get the implied volatility. I have one numerical example here. So this example says a call option on a non-dividend paying stock has a market price $2.50. The stock price is 15 and the strike price is 13. Time to maturity 3 months. Risk-free rate 5%. What is implied volatility? So what I've done here is sorry, let me just close that. So what I've done here is I just type in the Black-Scholes formula into our spreadsheet, right? So those are the parameters. So that is the ND1, and that is your ND2. So that's your D1 formula. So that's nothing, just me type the Black-Scholes equation into the spreadsheet, and that's your D2 formula. All right, so I have the Black-Scholes option pricing equation typed in the spreadsheet. And what do we know? We know that the share price is 15, right? So the S0 is $15. And strike price is 13. Time to maturity 3 months. So 3 months in a fraction of a year is 0.25. And then the risk-free rate is 5%, right? So that's just the 5% there. Now I try to work out what is the volatility that people to use to price this call option. I need to find a sigma so that the call option price will equal to $2.50. Now, by working out the sigma, we're getting this implied volatility, the volatility implied by the option price that currently trading in the market. Everybody understand what I'm doing here, right? So I try to back out the sigma here. Now, the way how people back it out is using so-called reiterative procedure. It's just a fancy way of saying try and error. So we're going to try a lot of value, then we're going to get the call option price that's most closely to $2.50. Right? So what I did first is, you can try something like 10%. Oh, sorry, you can try something like 10%, and you get a call option price like $2.16. So that's way low compared to the market price, $2.50, right? Now, as the previous slide I mentioned, higher volatility always means a positive effect on the call option price. So perhaps we need to try something higher, something like maybe 20%. So let me try 20%. Now, if I try 20%, I get a call option price slightly higher, but not enough. We want the call option price to be $2.50, right? Then we can try something like 30%. Still not enough, right? It's only $2.30. We want $2.50. So we can try something like 40%. 40% is pretty close, right? But that's higher than $2.50. So that's $2.51, right? So perhaps you want to try something like 39% volatility, slightly lower. Then you'll try something like, and that's pretty close, right? So basically, by using this try and error reiterative procedure, we work out the implied volatility is 39.6%. So that's how people using the option price they observe in the market and back out the sigma. And this implied volatility is used in the market. So if you search VIX index, so VIX index is implied volatility that backed out from the option price. if you look at the VIX index, you can see clearly that the implied volatility spike up around 2008 global financial crisis, right? So people start to panic around that time. And you see that there's a lot more volatility around this dot-com bubble, right? So from 1998, so that perhaps that's the Asian financial crisis, and all the way to 2000, so that's the height of the dot-com bubble, right? So basically people use the implied volatility as kind of forward-looking device to get a sense of feeling how volatile the future is going to be. And then they're going to make their portfolio construction decision based on this implied volatility information. Okay, so that's your implied volatility. And lastly, let's have a look how we're dealing with dividends. Okay, so basically the way we're going to deal with the dividend paying stock is very similar to the way we trade dividends in the futures pricing. Basically, we simply subtract the dividends, we subtract the present value of the dividends from the current share price as 0. Okay? So basically, what is the ex-dividend day? Let me explain what is the ex-dividend day. So ex-dividend day is the one day before the recording date. If you bought the stock at ex-dividend day, or if you bought the stock at post-ex-dividend date, you are not entitled to the dividend. However, if you have the ownership of the stock before the ex-dividend day, you are entitled to the dividends. Now, after dividend day, what the market will do is they will correct the price, so they will trade the stock price downward. The magnitude of price decrease will be identical to the magnitude of the dividends. So that just market reflects the fact that that amount of cash is paid out to the shareholders. Okay? Now we're going to do exactly that correction to our stock price S0. So that's the formula. So you look almost identical to the original formula. One slight modification we have done here is we simply subtract the present value of the dividend from the current share price, right? So we do that here, and we do that in the D1 and the D2 calculation. So read this question. It says, consider a European call option on a stock with ex-dividend day in 3 months and 7 months. So that's the date where investors start to correct the share price, and we're going to do so. The dividend on each ex-dividend date is expected to be 75 cents. So one 75 cents in 3 months' time, another 75 cents in 7 months' time. And the current share price is $30. Strike price is 29. The stock volatility is 25%. Risk-free rate is 8%. Time to maturity is 9 months. And what is the price of this call option? So very similar to the way we're dealing with the dividends in the futures price. First, we discount these two dividends back to the present, right? So the first 75 cents in 3 months' time, so that's 75 cents times e to the power of minus 8 times 3 over 12. So that's just us discounting back 3 months. And similarly, we're going to discount back the second dividend, we're going to discount back 7 months, and we get the sum of the present value of the two dividends are $1.45. And then we're going to subtract the $1.45 from the current share price 30 throughout the calculation here, right? So that's the D1. When we calculate D1, we subtract $1.45 from $30 price. And we're going to do the same in the Black-Scholes option pricing formula. So the current share price is simply the 30 minus $1.45 times ND1. So you can look up this in the probability table. So that corresponds to a probability of 0.62. And minus the present value of the strike price and times the ND2. So you can look up this probability in the table. It gives you the call option price is $3.11.
right? So nothing difficult here. It's just one slight modification. We subtract the present value from the share price. Okay, so we finished the lecture here. I think it's too early, so perhaps let's finish off the option trading strategies from week 4. What do you think? Or you guys prefer to do it in Thursday workshop? Thursday workshop or today? All right, so I think you guys deserve a break because you've done the mid-semester test last Friday, and I really appreciate you guys come here today. So let's call it off. So we're going to do the option trading strategy. We're going to finish the strangle strategy. We're going to finish butterfly spread in Thursday's workshop. All right, and I'm going to introduce the alternative way of constructing the bull spread. Remember, we construct the bull spread using calls. I'm going to tell you, you can actually construct bull spread using puts as well. Okay, we're going to do that in Thursday workshop. Thanks, guys.